crude oil going down and gold going up, and industrial metals flat. Now, copper's a little bit stuck because of tariffs. We have to worry about, and it would be wonderful if we look back at this year and say, oh, that was just a dip to buy and we're okay. But my bias is it's more likely that this hopium that it's over is overstated. That recession we didn't get in 2023 is kicking in. And the bottom line, though, Kai, is when you get the U.S. stock market cap to GDP at 2 times and the highest ever versus the rest of the world, it's all that matters in the economy.
Hello and welcome back to Soar Financially, a channel where we discuss the macro to understand the micro. My name is Kai Hoffman. I'm the EdJR mining guy over on X, and of course your host of this channel. And I'm looking forward to bringing back Mike McGlone. He's the senior commodity strategist over at Bloomberg, and we spoke April 4th, I believe, right after Liberation Day. A lot has been going on in the markets, and Mike had some perfect commentary for us. It was widely viewed, close to 80,000 viewers of the last video. And I saw Mike just earlier this week in New York, and I figured we need to catch up. We need to get on record what his thoughts and views are post tariff truce. And of course, there's a lot of turmoil on the bond market or in the bond market that we need to put some context around. So very timely discussion. But before I switch over to my guest, hit that like and subscribe button. Helps us out tremendously to grow the channel and attract a wider audience, and it is much appreciated. So thank you so much for doing that. Now, let me switch over to my guest. Mike, it is great to have you back on the program. It's good to see you again.
Good to see you, Guy. Thanks for having me.
Absolutely. Yeah, Mike, about 6-7 weeks post Liberation Day, a lot has happened. A lot of sable rattling, of course, 6-7 weeks ago. But it feels like we're in deal-making mode now. Put some context around it for us. Where are we at, Mike?
Well, I think the macro bottom line is the stock market. After that, the bottom, the S&P 500 was down about 15%. That was basically about April 8th or 9th. And right after that, I think it was April 9th when Mr. Trump came out and said, oh, okay, well, we're going to delay the tariffs, going to add 90 days a little bit too. And I think it's a classic example of what really matters in markets. Stock market should go down, and all these aggressive plans will be pulled back a little bit. So we've bounced back to unchanged on the year. And Bitcoin is bottom. The bond yields have gone down and then back up. And one key commodity that's still staying down is crude oil, and one that's staying up is gold. So where do we go from here? And my main key theme is the bottom line is we're taping on May 22nd. And just today, that U.S. Treasury 30-year yield reached the highest level in about 20 years at 5.15%. That's a big problem. Bond yield spiking is not a good sign for the U.S. stock market, particularly when the goal is to get stock prices to go higher. So I'm looking at this whole space as we've had a significant correction, then bounce in risk assets. And now the risk is they all roll over. And to me, that would really legitimize gold being up almost 25% on the year and crude oil being down about 15% a year. If the stock market recovers and goes higher, that might make elevated gold a little dicey.
Yeah, we got to put some perspective around the commodities complex as well. You just said it. Risk seems to be back on. People are selling out of bonds, or are there different, what do you call them, currents now? It doesn't seem as straightforward anymore because it's not like a risk on or risk off scenario anymore. I think there's more to it, as you said, because all of a sudden Bitcoin is flying. Gold is holding steady, like we're pretty much flat since, and the stock market is okay. I'm just looking at it here. The index is actually up right now, 0.15%. So it's actually green as we speak, Mike. Put some context around that for us.
Well, that's the key thing is, so we've had a major swoon and a bounce. And the consensus I saw in some of the Bloomberg chances, oh, the crisis is over. I'm like, good luck with that one. To me, the biggest tailwind in risk for this year is that we end the year with the U.S. stock market down. Now, that's what you've really seen, to me, priced in from collapsing crude oil and rallying gold, is that it's tilting over, it's showing that global deflationary trajectory. And what we just did is we bounced up on the year after being down. To me, that was the feint. And the risk is we go back down. We squeezed all those shorts. And one key difference that I like to point out is the last time we had a similar sharp drop and then recovery was Q1 2020, right at the outset of the pandemic. And for that situation, at least in the U.S. and most of the rest of the world, we saw the biggest money pump, fiscal and monetary stimulus, most notably monetary ever. Wrote checks to people, so that flush came right back, and it started the foundation for the rally we're in now. That's what's different now. We don't have that. We have austerity, we have tariffs, we have We have something we have to do to cut back in the deficit, and we have a Fed that cannot ease anymore because risk assets went up so high, including cryptos, and created so much inflation. We're at the end game. So to me, the biggest risk is that U.S. stock market rolls over, and that, like I said, would make sense for gold to stay up this amount. So the wonderful thing is, so I'm looking at, we're almost towards the end of the first half. We can get through this year with the U.S. stock market unched. That would be wonderful. But to me, what we're seeing now is, like, on a 1 year, just on the year basis now, the MSCI ex-US stock index is up 16%, and the S&P 500's flat. That ratio, the S&P 500 to the rest of the world, has stuck between 1 to 1 for about 40 years, and then shot up to almost 2 to 1. I think it's starting to revert lower. To me, it's an example of, it's become somewhat prudent to sell U.S. assets. You're certainly seeing that in bonds. I certainly seen the dollar, despite the fact that the dollar and the U.S. stock market has been on basically the same chart syndrome for almost 10 years. The dollar's still down almost 5% in a year. So to me, that tilt is back downward. And I think we're going to look back at this period from the end of the year. It's like, oh, the market gave you a chance to sell U.S. stock market. And one key thing that's a lose-lose for the stock market is spiking bond yields. It's just never good when bond yields go up and the Fed's trying to ease and they can't. That's just not good for overvalued U.S. stock market.
Yeah, like I said it on stage in New York as well. I was a bit bummed out to see that the S&P reach flat levels again or break even for the year, because it's not good for the mining complex when you can actually still chase, or believe that you can still chase, returns in the main markets here. And like, I think we spoke about that as well. Like, for me, I need to see capital start to reallocate, start to move and roll over into other asset classes, which for me, of course, is the mining complex. Do you see false hope being created here? Meaning, is that debt cat bounce, creating a false illusion that we actually might be able to achieve 20% again this year?
So 20. So here's the facts. Since 2019, the S&P 500 total return is over 100%. The peak was about 110%. I mean, that's pretty significant outperformance, but for a good reason. It was the biggest money pump in history, and all the lessons of history is when you add that much liquidity to the system, you pump risk assets, you get. Typically, that's inflation. You almost always get deflation from that inflation. Now, we're seeing in China, certainly with that Chinese 10-year bond yield at about 1.7% versus in the U.S. about 4.6%. Seen in China, we're seeing bounces lately being mostly Europe. Germany, as you know, has had 3 years now of stagnant, virtually tilting over to recessionary growth. And you're seeing in things like crude oil going down and gold going up, and industrial metals flat. Now, copper's a little bit stuck because of tariffs. But to me, that's the tilt that I think we have to worry about. And I would be wonderful if we look back at this year and say, oh, that was just a dip to buy and we're okay. But my bias is it's more likely that this hopium that it's over is overstated. That recession we didn't get in 2023 is kicking in, and you're seeing a lot of data in the U.S. Not the backward working in data, but you're certainly seeing in consumer spending, auto loan defaults, credit card issues, and things like that. And the bottom line, though, Kai, is when you get the U.S. stock market cap to GDP at 2 times, and the highest ever versus the rest of the world. It's all that matters in the economy. The best examples in history, as we mentioned probably earlier, was 1929 in the U.S., 1989 in Japan, 1999 in the U.S. wasn't even nearly as expensive. The stock market, because it becomes the economy, and that's why my point is the next key risk is everything is that U.S. stock market goes down. It takes away some of the, the tide goes out and we see who's wearing clothes. And I think gold is picking up on that.
Yeah, it seems like it. But I've got one more follow-up on the main markets, because on Monday was the biggest, what would you call it? Like, it was actually historic, because retail bought over $4 billion worth of stock before 12 p.m. That was quite historic. What's wrong with retail? My question is, help me analyze it, Mike. Like, a bit of a psychology lesson, perhaps. But why is retail buying the dip so aggressively here?
So think of the lessons of history. The only thing that stops typically from retail investors to buy the market is the market going down. That's the only thing. Typically, when you get to a stage like this where you just have to keep up, you have to keep up with your beta, and you get to excessive leverage. I've been reading about tons of excessive leverage and things like Bitcoin now. And I do love the mantra when people say, oh, it's a triple top or something like that. And I always like to say, well, it's one of my favorite technical indicators. If it goes up, it's going to go up. So I think we've reached near that apex. Now, you can never really pick a peak. It can last forever. But that's the key thing I was pointing out with gold taking off, the bond yield spiking, and the stock market giving you that chance to sell. It's very scary. So that's my point, is typically it just has to fall on itself And retail will not sell until it goes down. They clearly know it's going to keep going down, which means a typical enduring bear market. But that's my point. When you get to 2 times GDP, you have to look for alternatives. Number one has been gold. Typically, you look for things like treasuries, and treasuries are doing okay if you don't go too far out in the curve. You're still getting that yield, and you're not getting much returns in the U.S. certain stock market not this year. And then people are stretching out to very highly volatile and speculative cryptos, which I view as doubling down on the risk. That's why I stick with this year. I still think gold's going to be one of the best performers. It has been. It's up 26%, but Bitcoin's up almost 20% now, so it's caught up. And that's the key thing I'm worried about is virtually never, unless you have some kind of event, like I remember 9/11 really triggered, we were already in a downtrend and that kind of accelerated the downtrend. This one's going to fall on itself. And that's why I don't know what the catalyst is going to be, but I do, when I see like today, that 30-year spiking to 5.15%, it's not a good sign for risk assets.
Yeah, it seems to be like it's more on the tail end. Like the 30-year and the 20-year have spiked to those 20-year highs. Like the 10-year is still, like it's still catching up. It's not there yet. I'm a little worried that we're interpreting too much, perhaps, into the spike. Do we run a chance of that? Have you looked at both scenarios, whether this is just a short-term moment? Because yesterday we've had that botched 20-year auction that probably caused a bit of turmoil here as well. Or is that a longer-term trend?
This is a bit of that's the thing. It's the consensus is that the long-term trend in yields declining from the peak in the 1980s to basically near zero just a few years ago with COVID, and then that big spike. A lot of consensus is that trend's over. I dispute that, and I particularly say why I dispute that is because of rapidly advancing technology, creating more and more deflation every day, and particularly like the example Scott Bessent uses out of China. The whole world has to have major tariffs against China now because of the major deflationary forces coming out of that country. And then I point out the bond yield at 169. That's very similar to what I saw in Japan in the early 90s. So to me, that is the trajectory that we're in. And I think it's when the opportunities come to market, when you look at markets and think, okay, the macro for deflation is probably is more significant than ever. We've had a major jump in bond yields, and now the consensus are going to keep going up. That's when it's time, I think, to go back to the long-term enduring trend of what happens with humans. We create massive deflation unless we debase it away. And I've been wrong on bonds for about 2 years. But one thing I really noticed is the things you really see in commodities. Crude oil's collapsing. I mean, it's not so much, it's less collapsing, just going back to its mean. The price on the screen right now is $60 a barrel WTI crude oil. That was about the average price in 2019, before that massive money pump and Russia's invasion of Ukraine. So what does it do when you spike prices and things are elastic, like crude oil, less so the metals and the grains, is you incentivize that supply, you cut back demand, and prices go down. Now we're still in that downward trajectory. So that to me is where I see from commodities, I see clear deflationary forces, most notably because of technology. And the question is, how much does that trickle down to the rest of the economy? So I like to use this. The final pillar for normal deflation from inflation, which is what I presented on the conference, is U.S. stock market. If it just gives back, say, 20% of those 100% gains since 2019, that's what's probably going to need it for the Fed to ease, for us to tilt over. And that's where the deflation starts kicking in. That shuts off the consumer spending, that people have been so pumped up by this wealth creation there, they get addicted to it and they forget what life's like without it. And that to me is part of what the end game is. So we've reached an end game, I think, with the Fed being able to ease and elevate risk assets and not create inflation. Well, we have elevated inflation because they eased too much last time and risk assets are too high. They try to cut back on that. And when they cut back last year, bond yields went up and told them to stop easing, yet they still did a little more. And now the problem is I think they know it, though. The number one trigger to get the Fed to ease, get yields to go down, is probably the stock market going down.
Yeah, it doesn't look very likely right now. I know it's shaky. I think we're all, like, a second something happens, everybody runs for the door. But I don't see it happening. I think the Fed is rather, like, I don't know. I have a hard time, but I see them almost hike rates based on bond market and inflation data, right?
That's what the bond market is telling them.
Yeah. No, exactly. Quick question. I'm not sure if you can answer it, but somebody brought to my attention the Swiss 2-year yield is negative.
Yeah.
And I wasn't aware of that. So a lot of money piling into there just to protect, I guess, something. What do you make of that? Is there any context or anything to be interpreted into that?
I think we're turning Japanese. So I just pulled up my monitor on the terminal, and it shows indeed Swiss yields are negative. but you look at 2-note yields in, say, I like to look at this in the U.S. 4%, right?
Yeah.
In Canada, 2.7. In Germany, 1.8. In China, 1.4. So that's the key thing I like to point out on a global basis. I usually revert back to my 10-year note, where you have the U.S. at 460 or so, and in the next largest economy at 170, China and Germany at 260. That to me is the nail that the hammer when falling beta is looking to hit. So that's the only way to really sustain those U.S. yields that much higher than the rest of the world. Now, yes, there's issues of debt, obviously deficit, and U.S. has pretty high credit default swap levels right now, which is usually a sign of peaking risk. Is for the U.S., that's where the U.S. stock market kicks in. We've been able to maintain these high yields, and they are high, partly because some of this because the stock market's so high, and that's where I can't stick with that sore thumb. If beta drops, those yields are going to be some of the places we're going to hit, and then the whole world follows the lessons of Japan. And I think Switzerland is just one of the first examples of us going back to turning Japanese, like they did in the 90s. Now they bounced out a little bit, but here's one thing I like to end with. I like to use the example of the 3 largest major economies in the world who are major net exporters are China, Germany and Japan. Their average net exports are almost 50%, well, 25% of GDP. In Germany, it's almost 50% of GDP. And the total of their GDP is around 3 trillion, about the same as US. And the average of their 10-year note bond yields is around 2%, versus the US is more than double that. And now they're being shut off by being unable to export to the US, at least for now, at least curtailing some of that, not shut off, but limiting it. I just see that global deflationary recessionary trajectory potentially more likely to accelerate, and that's what you see in commodities. I've been pointing this out for a while. With gold outperforming everything, gold's made a new high versus industrial metals, versus the Bloomberg Commodity Index. It's finally catching the S&P 500. It's the gold copper ratio, the gold crude oil ratio. They're all pointing that way. And the one thing to legitimize it, with the U.S. stock market goes down, if the U.S. stock market keeps going up, that might make it a little dicey. But to me, that's the tilt, and we've had a little reprieve in that tilt. What do you want to do? Is the way I look at it. And I think most of the smart people in the world who trade leverage money and have optionality, they might have been stopped out initially. They'll try it again, and that is shorting things like beta, which is the U.S. stock market.
Let's talk commodities. Let's maybe start with oil, because it seems like there's a bit of a political agenda behind it as well. Some guests have commented that maybe deals have been cut with Saudi Arabia and other Middle Eastern nations, potentially IP knowledge transfer and things as trade-off for more oil production to keep prices lower. What do you make of that? Do you care to speculate on that, Mike?
Absolutely. You can't ignore any of the politics in crude oil, partly because it's crude oil and politics really matter. Let's start with the vested interests of the current government U.S. They have a vested interest in lower crude oil prices, lower energy prices, lower bond yields. They will get them, partly because the trends were pre-existing towards lower crude oil before they came in the office. So the key thing I want to point out about is crude oil is I made the call for it to go to 40 when it was trading above 100 in 2022, and I still stick with that, partly because the average cost of production in this country is between $50 and $55 a barrel. In the last 20 years, every time we get much above 100, we always have to go down to 40 to shut off those supply excesses and declining demand, and we're seeing it clearly on a global basis. So I still think crude oil is going to bottom and get below $40 a barrel. The high last year's low is 65. And when people talk bullish crude oil, I'm like, why? First of all, you need the stock market to go up for it to stabilize. If stock market does this scenario, I think just drops 20% in the year, that pushes crude oil to 40. But it's done it the last 20 years. And most of those periods, the U.S. was not as massive an exporter as it is now. So if you look at U.S. net, what used to be net imports are now exports, almost 4 million barrels a day. That's crude oil and liquid fuels. You include Canada, it's almost approaching 7 million barrels a day. OPEC's coming back on. Why are they coming back on? Because they curtailed. They held back on their production for a while and their exports for a while. Now they have to bring that money. It's just a classic bear market, and it hasn't even got cheap. That's my point. Typically, bear markets get cheap, and we're just heading that way. The key question is what's going to make it difficult. And I do enjoy what's happening with the bromance between Saudi Arabia and Mr. Trump, and that's clearly biased towards lower prices. And let's think about what's happening. We have a significant war going on in the world, and the aggressor was a pretty significant energy producer. What hurts them most? Lower crude oil prices. Now, I wrote about that in 2022, and we're going that way now.
Yeah, I joked. I think Lobo Tigre mentioned that on our program when I saw him at our show last week. And he's like, well, weren't the sanctions at $60? So we got to get below 60 to start hurting people. economically.
Yeah.
I mean,
Yeah.
have you ever done the math? Oil price versus inflation. Let's assume oil does
Oh,
drop
sure.
to 40. What does it do to the U.S. inflation?
Yeah, I just sent to editorial that I'll be publishing that on Friday. We're taping on Thursday, May 22nd. That it's an oxymoron to point out crude oil prices are plunging and U.S. bond yields are spiking. Bond yields almost always, the number one thing that affects U.S. bond yields is inflation, inflation, inflation. Everything else is about a 1 compared to that's the 10. Even deficits. Typically, the biggest deficits come in recessions when yields go the lowest, i.e., look what happened with JGBs. So I point out that it's very rare for crude oil to collapse and bond yields to go up, and even copper is doing very well. So at some point, that crocodile jaw is going to narrow. I don't see what really gets crude oil up other than some kind of supply shock. I think the biggest tilt is that's why I always have to tilt back to what's going to really matter for these markets is bond yields have been able to stay high. Copper's been able to stay high because the U.S. stock market's bounced. Now, if that rolls back over into what people know is going to be a down year, right now they're just assuming it's going to be up year, it all goes back downward. And to me, this is kind of a bit of a flux in that trend. But it's very rare to say crude oil is collapsing and bond yields are going up. I remember trading in the trading pits in Chicago in the 80s, and we traded bond futures, but always watched crude oil.
I have a couple more questions. I know you have a hard cutoff here in 5 minutes. That's why I'll keep it short.
Okay.
Spending bill and tax bill has just been passed in Congress overnight. Any foreseeable impact on the commodity complex here for us?
Not really commodities. I think the key thing is if there's going to be massive deficit spending, it's going to keep gold bid, and gold's already kind of priced in for that. It's up 26% on the year or so. So gold's already done that. I don't know if it's going to really change much. In the agriculture sector, we're all looking for some form of demand, maybe more for biofuels, and that's probably not going to make a big difference. Compared to the crop this year, it's bigger. And then for the oil, we all know it's the whole Trump administration focuses for lower energy prices in crude oil. So I don't think it's making a big difference in commodities.
Okay, no, fair enough. Tariff truce with China. The U.S. wants China to buy more from the U.S. Any impact? Let's broader commodity space. You just touched on agricultural products because I think that's pretty much everything or anything that China buys from the U.S. anyway. Any impact to be foreseen there?
Good luck with that one. First of all, their main imports of soybeans and corn now coming from Brazil, mostly soybeans. And every day that goes by, they're adopting newer technologies like GM seeds and stuff. So actually, their demand is declining. Their imports are declining. So yeah, they might import some more soybeans and corn from the U.S. and some grains. But for them to actually buy U.S. products, I'd say good luck with that one. As Scott Besson said, they are like the broomsticks in Fantasia in terms of exporting and creating massive deflationary forces in products and things for sale, most notably renewables and electric cars and solar panels and stuff. And there's no self-correcting mechanism in that country. So it's not a consumer-driven country. It's a producer, exporter country. So good luck with that one. And at least tariffs. The thing is, I look at China as very similar to the way I looked at Japan and what happened with Japan when it peaked in the 90s. And it was in a recession and deflationary recession until now. And that's where China's heading now. We're turning Japanese.
No, absolutely. I do agree on that. Mike, very last question. Your presentation in New York, deflation, post-inflation. What was the main key takeaway that if anybody left the room like after your presentation, like, okay, that's the one thing I want them to take away from my presentation?
That it's normal, it's abnormal to continue doing what we are now, to stay 2 times market cap to GDP, the highest stock market capitalization ever versus in the U.S. versus the rest of the world, without some kind of normalization in that trend. It's very abnormal to do that. To look back from this history and say it was different, I think good luck with that one. And that's why I like to point out why. So I think gold's figuring it out. Crude oil's figuring it out. Copper's got a problem. I think copper's more likely to drop towards 3 than stay above 5. The key takeaways, this is a normal situation. And I think I like to remind people is mean reversion can be a powerful force. And this is just normal mean reversion. Now, commodities are starting to do it. Now it's the rest. The key thing is the risk assets in the U.S. are just starting to mean revert. And it's becoming prudent from even an American standpoint to offshore some of your really elevated assets overseas, and a lot very prudent for any overseas investors who've become way overweight the U.S. to sell rallies.
Fantastic. Mike, really appreciate you jumping on here short notice with me. Too bad we couldn't record this in New York in person. Next time we just got to do it over a beer. That way it'd probably work out.
Love that.
So fantastic. Mike, thank you so much. Where can we send our audience if they don't know where to find you by now?
Well, first, I like being on your program. I'm on the Bloomberg terminal, on X, at Mike McGlone 11, on LinkedIn, Mike McGlone, Senior Commodity Strategist. I'm on Blue Sky too. Just search for Mike McGlone, Senior Commodity Strategist at Bloomberg. And thanks for having me, Kai.
Absolutely. Anytime, Mike. Thank you so much. And everybody else, thank you so much for tuning in. Tremendously appreciate you watching and supporting this channel. Please hit that like and subscribe button. Leave a comment down below. What do you make of the recent tariff truce between the U.S. and China? How do you see the spending and tax bill that's just been passed in Congress? How is it going to affect the commodity complex? Curious to hear your thoughts. Put them down below and we'll make sure to incorporate those comments into some of our next conversations. Thank you so much for tuning in. We'll be back with lots more. Take care out there.